Hello there. Welcome back to Financial Accounting at 5. Today we want to look at a question paper of June 2021. We're going to look at question 5 of that question paper. So we're going to go through the question. This question is on financial indicators, that is ratios. So remember, the ratios are used to analyze and interpret financial statements. Usually, they are applied by the management of the business when they want to see how the business is operating. So in terms of 5.1, which is the first question, it reads, name two users who are interested in the information contained in the financial statement. So users of financial statements, we know them. We have internal users of financial statements, and also we've got external users of financial statements. So let's see what we have. On this first part, that is 5.1, we are going to list the users. So we can start by the internal. We're just going to list them. Remember, there are only needed two here. We have got managers of the business, one of the users, and then we can as well try to see why they need these financial information. They need they need to make their decisions. When they're making decisions, they make the decisions based on the financial statements that will be there in terms of the position of the profit, and also the position of the distribution of assets and liabilities and equity, that is the balance sheet. So when managers, that is what we have. Then also we have got internal auditors, also users of financial statements. So these are two internal users of financial statements, that is managers, and also we have got their internal auditors. So there we have internal auditors in the second. Internal auditors, they use these financial statements in terms of, remember, the internal auditors are there to make sure that internal controls are being followed. Preparation of financial statements, the accounting people, are they abiding by the international financial reporting standards? Are they also abiding by the general accepted accounting practices, that is GAAP? These are internal, concepts or principles that should be followed. So this is what we have in terms of internal users. We can also have investors also can also use this financial information. So they also require to see these financial statements. Investors, when they want to see whether they can invest in a business in terms of buying of shares, we also have investors, and also we have got banks in the form of financial institutions. When they want to extend their credit to firms, when the firms are borrowing money in the form of loans, they also try to see whether this firm is viable, is going to pay back the money without any problem. So these are the users that we have. We have got four that we have there. So the first one and second one comes as internal users. Then third one and fourth one are the external users of financial information. So I will go back to our second question. So we're going to read what we have on the second part. That is the question that we have there reads, you are presented with the following summaries of summer trader for 2 years, for October 2018 and October 2019. So we are given a trial balance that we have there in terms of 2018 and 2019. And then they have the information that is listed there. And then we've got additional information that we have there from A to C. And also we've got some lists there in form of a trial balance again in terms of purchases, sales, and other expenses. So we go back to see what we have in the form of the first question regarding those trial balances that we have. So if you go there, you'll see that on 5.2.1, we've got to calculate the asset test ratio. So we go back there. We need to first of all put down the formula for asset test ratio, and then we can then substitute the figures there in the formula so that we can get the correct answer. So this one is 5.2.1. 5.2.1 is on asset test ratio. So the formula for asset test ratio, remember, is current assets. We subtract trading stock, and then the answer that we are going to get there, we make it as a ratio to current liabilities. So remember, we are going to leave this ratio in the form of the current liabilities side is going to remain as 1. So this side we have 1. So it means the figure that we are going to have for current liabilities, we're going to divide it both sides. In other words, we are saying here, we are saying over current liabilities, the figure that we have, and then we divide it both sides there. So so that it we leave it in the form of the right side being 1 expressed as 1. So we go to the list of balances that we have there and try to see the figures for current assets that we have. So we have inventory is one of the current assets that we have there. Inventory is here. And then we have got also bank, but if you see bank, we have got nothing there. But for 2018, there's something. So remember, this when they ask these ratios, they are asking you to calculate in the current financial year. So our current financial year, according to the question that we have, is 2019. So we've got nothing in terms of bank. So we're not going to put anything there. Then we've got what debtors control also is a current asset. We've got 125,000. Remember, you are also supposed to differentiate between non-current assets and current assets. Remember, current assets, remember, these are resources of a business that are expected to stay at the business for a period of less than a year. We've got examples, we've got inventory, we've got bank, there's a petty cash that is there. They fall under current assets. And in terms of prepayments of expenses also, and accruals of income also fall under current assets. So make sure you are able to identify them, because if you look at the question that we have, we are not given the categories. They're not listed in categories there. They are just mixed, the current assets and non-current. So you are supposed to pick them. So this is what we have there. On current assets, we've got 310 plus 125, and then we are going to subtract again 125. Sorry, we are going to subtract the figure for inventory is 310, so we're going to subtract 310 there. So we can come here and just present it as it is. There we are saying there 310 plus 310 plus 125, 310,000 plus 125,000. And then the answer that we are going to get there, you also subtract 125 now for trading stock. So this is what we have on the part of the current assets minus trading stock. Then for current liabilities also, we need to see what we have. You can go back to the list of balances that we have and try to see what we have in terms of current liabilities. So current liabilities, remember, these are amounts that the business is owing, and we expect to pay these credits within a period of 1 year. So we've got trade payables, also current liabilities. Trade payables or the creditors control or the creditors, they fall under current liabilities. And then we are seeing that we also have bank overdraft there. It's also a current liability. Remember, when it's a bank overdraft, we are saying it's a credit balance in the bank account. It's a credit balance in the bank account, and on the bank statement, it will be a debit balance. So what we are saying is the business has withdrawn more money than what is in the account. So it has a negative balance. So we put it under current liabilities. But if it's a positive, we're going to put it under current assets. So we have got 98,000 for creditors control, and then we add 48,700 on the part of current liabilities. So as well, we can go that side and try to see, put those figures that we have there. So we are saying 98,000, 98,000, and then we add 48,700. So this is the side of current liabilities. So if you calculate these figures, you'd see that on the part of our left-hand side there, we are going to be left with 125,000. We are going to be left with 125,000. So we can reconfirm the figure for trading stock there. What we have, trading stock inventory, we have got 310. So here we're supposed to subtract 310. Here supposed to be minus 310. So we are saying 310,000 here. So we are saying if you calculate correctly there, you're going to get both 310 minus 310 is you're going to get a 0, and then you're going to be left with 125,000 only. So we're saying 125,000 S2. And then we add 98,000 plus 48,700. You're going to get 146,000. Let's try to see what we get there. If we say 98,000, and then we add 48,700. you are going to get 146,700. So here we have got 146,700. So remember, this side is we are going to leave it as expressed to the ratio of 1. So we divide by 146,000 both 146,700 both sides, 146,700. So this is what we have there. And then obviously on this side we are going to get a 1. So we express it as a 1 there. Then we say 46,000, 146,000 there. Here we've got a 1 that is here. 140,700 into 125,000. If you punch it correctly in your calculator there, you're going to get 0.85207. 0.85207. So according to the instruction of the question paper, you have to check at the beginning of the question paper there, they tell you you are going to round it to how many decimal places. But in this case, we are going to round it to the nearest 2 decimal places. So 2 decimal places we are here. We check the figure behind the second decimal place. We've got 2. I see the range 0 to 4, so it doesn't change 5. So it remains a 0.85 s to 1. So this is our answer on acid test ratio. Then we go and check again what we have in terms of the next question. So on the part of the second question, we have got net profit percentage. Net profit percentage. So as well, we are going to put down the formula first, and then we can simply just substitute in the formula, get the correct ratio there. So we are saying this is now 5.2.2. So 5.2.2 is saying net profit percentage. So the formula is net profit over turnover. Net profit over turnover. Net profit over turnover. So what does turnover mean? We're going to explain that. Then we multiply by 100 over 1. Remember, turnover means sales minus sales returns. If you've got returns that are given in the question, we're supposed to subtract them from sales. Then we get your turnover or the net sales figure. But it depends on the question. Like this question, we are not given the figure for sales returns, so we are just going to pick the figure for sales that we have and to represent our turnover. So if you go to the balance that we are given there, we have got sales here, cash sales. We are given cash sales. We are given credit sales. So to get the total figure for sales, we add 600,000 plus 680. So we are saying here 600. This is now the figure for total sales, 600,000. And then we add 680,000. So if you add the two correctly, you are going to get 1,280,000. So you've got 1,280,000. So this is the figure that we have for our turnover. Remember, our turnover is the denominator there. And then we also have to calculate the figure for net profit. If you look in the question there, we are not given the figure for net profit there. So we need to calculate the net profit first. Remember, the formula that we deduce from the trading account, we say gross profit is equal to opening stock or opening inventory. We get purchases, we subtract purchase returns if they are there. Then we add carriage inwards. If we have got customs duties also, we are supposed to add them there. And then obviously we subtract our closing stock. But according to the information that we have, we do not have some of the elements. So here we're just going to say opening stock plus purchases, then we get our closing stock. So after getting our closing stock, we now subtract the other expenses figure that we are given in the question. So for our opening stock, we are going to get, and then after getting the figure for gross profit, we are now going to say our net profit is equal to gross profit minus expenses. So we have got a figure that we are given for other expenses here. That is the figure that we are going to put on expenses. Then now we can now substitute our formula so that we get our net profit. So opening stock, we go to the question to see what we have in terms of opening stock. We have inventory here. Remember, we have got 2018 figures and 2019 figures. So opening stock is in the column of 2018, that is 95,000. Then we add our purchases. We have got purchases that we have there. And then we subtract the closing inventory, which is 310,000. Yeah. So we are coming here. We are saying opening stock. We have 95,000. So this one we are substituting into this formula, 95,000, and then we add Purchases, remember our purchases, we've got cash and credits, we add them all of them, which is 468,000 plus again 150,000. Then we subtract our closing inventory. Remember, closing inventory is 310,000. Then we get now our gross profit. So if you calculate that one correctly, let's try to calculate and see what we get there. We get 403,000. 403,000. That is the figure for gross profit. And then we now go to this formula of getting now the net profit. Now we are saying gross profit, which is 403,000. Then we subtract other expenses figure, which you are having here in the current year, which is 320,000. Then we subtract it here, 320,000. Then if you calculate correctly, you're going to get 557,000. So we have got 557,000 there. Then now we go now to the formula that we have here, which is saying net profit over turnover. So our net profit, remember our turnover, we now have it. Our turnover, we now have it here. This is our turnover, 1,280,000. Then this is our net profit. So we can now substitute in the formula net profit over turnover to get the net profit percentage now by saying 557,000 divided by 1,280,000. And obviously, I'm going to multiply it by 100 over 1. So let's calculate it and see what we get. Then you'd see that if you calculate correctly to do 2 decimal places, you are going to get 43.52%. So this is what we have in terms of net profit percentage. Then we go again to see what we have on the next one is turnover rate. Turnover rate of debtors. Turnover rate of debtors. This is now 5.2.3. 5.2.3 now. Turnover rate of debtors. We are now on 5.2.3. So on turnover rate of debtors, the formula is equal to the formula that we use is credit sales over average debtors. So we are saying credit sales over average data. So this is the figure that we have. So we go back to the question to see what we have there in terms of credit sales. We have credit sales figure we are having the year. It's 680,000. That is our credit sales. So we can just indicate it here. It's here 680,000 representing our credit sales. Average debtors now we go to the total balance that we have there. We are going to add the figure for opening, debtors control, balance, and the closing balance for debtors. And then we divide by 2, which is 86,000 plus 125,000. So we go back to the question. We can start by calculating the figure for average debtors. I think this is the figure that needs to be pre-calculated before we substitute into the formula. So average debtors, we are saying 86,000 according to the balance that we are given there, and we add 125,000, 125,000, and then we divide by 2. We divide by 2 to get the average. So on the average there, if you calculate it very correctly, there you are going to say you are going to get 105,500. So here we get 105,500. So this is going to be our denominator there. Credit sales, remember, we found it there. It is 68,000. So we are now saying for now the form for the turnover rate of debtors, now we are now saying 68,000. This is now the turnover rate of debtors. We are now saying 68,000 over 105,500. And then remember, this we are going to leave the answer in the form of times. The number of times we are looking for the number of times that we are turning over. The number of times that the debtors are paying. The number of times that the debtors are paying. So here, if you calculate it very correctly, you are going to get an answer that you're going to get. We've got some decimal places that are there. If you round it off to 1 decimal place, 2 decimal places, sorry, it becomes 6.4 times. So this is our answer on the this second part of the question, which is turnover rate of debtors. Then we can go again to check the next question that we have. we have got average payment period to creditors in days. Average payment period to creditors in days. This is the average. On average, our creditors are paying after how long? That is what we are looking for. So remember, it's now indicated there. The keyword that we have there is that we have to present it in the form of days. So if we are presenting it in the form of days, we are going to multiply by 365, because the average number of days that we use in our calculations for indicators is 365, representing 1 year. If they want it to be presented in months, we are going to multiply by 12, because we've got 12 months in a year. So as simple as that. So we go there on 5.2.4. We again going to put our formula down first. So on average payment period creditors, the formula we are going to say average creditors, right, this is our numerator, and then we divide by credit purchases. Divide by credit purchases, and obviously remember it's going to be presented in days, so we multiply by 365 over 1 here times 365 over 1. So on average debtors, again, we are going to first of all calculate the figure for average creditors. We are going to add the two figures that we have there for creditors control, and then divide by 2 to get the average. So we are having creditors control. We are having 130,500 as the opening plus 98,000 as the closing. Then we divide by 2, get the average. So we come here again. We are saying 130,500, and then we add 98,000 here. Then we divide by 2 to get the average. So if you do that correctly, obviously, now we are going to have some decimals there, 89.10523. So this is what we have. So on this one now, we are now going to round it off again. Remember to 2 decimal places. We are going to round it off to 2 decimal places. So if you round it to 2 decimal places, we are here 0. Behind 0, we've got 5. So 5 will change our 0 to 1. We add the 1 there, so it becomes 89.11 days. So it means our debtors are paying within a period of 89.11 days. So remember, we're saying this financial indicators are used by the management when they want to evaluate the performance of the business. So this 89.11 days, we were told to interpret this ratio, you are now going to see that in the question we are given the credit term. The credit term, remember, on the company policy, we have got some credit terms that are there, that are what are we supposed to pay after how long. So if you go to our question, you'd see that we are told that creditors are allowed 90 days credit. So they can pay within a period of 90 days, which means 89 is within the range of 90 days. So there are no problems there because we are paying our creditors less than the company policy in terms of 90 days. So this is what we have in terms of this part of the question, which is average payment period. Then we can try to see what if you have got another question that we have there. Let's try to see this. We've got the last question, which is saying solvency ratio 5.2.5. 5.2.5. Remember, solvency ratio, it is a relationship that we have between total assets of a business and total liabilities of a business. So this is now 5.2.5. Solvency ratio, we say total assets as to total liabilities. So what are we going to do? We are going to say for total assets, we're going to add the non-current assets plus current assets. Then you get the figure of total assets. Total liabilities, we're going to add the non-current liabilities plus the current liabilities. Remember, the non-current liabilities are the long-term liabilities. We add the 2 to get the figure for total liabilities. Then we make a ratio there. It will give us the solvency ratio. So we go back to the question to check those figures for total assets and total liabilities. If you come here, remember, we are using the figures for the current year, which is our 2019. So for For assets, we are going to say that current assets have got a figure for 220,000. We add inventory 310,000. We add the debtors control 125,000. Then we get the total for assets. We are having the figure there calculated is there. Total assets figure for we have got 655,000. So no problem for that one. Then we go to for our figure for total liabilities now. We have got non-current liabilities that we have there, which is 55,000. So remember, capital is not a liability. Let's take note of that. Capital represents the owner's equity. This is the money contributed by the owner or invested by the owner to run that business. So we are saying 55,000 for non-current liabilities. We add our creditors control is a current liability, 98,000. We add our bank overdraft again is a current liability, 48,700. Then we get the figure for total liability. So let's try to do that. Let's try to add that one. So if you add, you would see that if you add this one, if you add this figure, this is 55,000 to 98,000, 48,700. You are going to get 201,700. Going to get 201,700. So we are going to say for figure for total assets 655,000 is to 201,700. So we just go to our answer section and just substitute those figures. We have got 655,000 as to our total liabilities. Remember, we got 201,700. So remember, this side we are going to present it or leave it as expressed to 1. So we divide by 201,700 both sides. Right. If you divide there, you see that the side will remain as 1. Then we divide the other side, we get 3.25 as rounded off to 2 decimal places. So this is what we have in terms of our solvency ratio. So remember, these financial indicators needs to be interpreted if given that question, but within the scope of this subject, which is financial accounting N5, we are not required to interpret. We are just supposed to calculate. So after calculation, now the management can now interpret the performance of the business basing on the results of these financial indicators. They can see if the business is performing well or not. So the comparison can be made in terms of the previous financial year to the current financial year, the movement that is taken place there. Is it improving or is it worsening? It depends on the interpretation and on the type of the ratio. And also it can be used to compare businesses, company A and company B, compare using those ratios. If you look at the net profit percentage, we compare to the other company, the one with a better net profit percentage will be performing better because it's got a higher proportion of net profit in sales or in terms of. So this is what we have in terms of this video. Let's stay tuned for more videos to come. Those who haven't subscribed, please subscribe and share. We are still coming as we prepare for our June exams. As for this video, I'm signing out.